Good morning, everybody, and welcome to the Mortgage Coach Friday Mastermind, where we always have amazing leaders bringing valuable information to the mortgage industry. Today, we have a hot topic. Inflation is a topic. In fact, I had coffee with Tony Blodgett this morning, Dan, and he's like, "Oh, I saw you have Dan Rawitch. What are you guys talking about?" And I'm like, "Oh, we're going to talk about inflation, friend or foe." And he immediately goes, "Foe." And I go, "Hey, I don't know what Dan's going to share, but I know this: when there is a challenge in the market, when there's confusion in the market, when 80% of the people say foe, or they say it top of mind, there is opportunity somewhere in them there hills, and we're going to find it." So I don't know if Dan's going to say foe. I'm going to find the friend in inflation today. So good to have you, brother.
All right, thank you so much. Good to be here.
So Todd and I are going to be the co-hosts. What's up, Todd?
Hey, not much. All of you know, I'm just a huge Dan Rawitch fan. I've been reading your commentary, Dan, for over, I guess, a decade now in Mortgage Coach. And it's, I love the little contrarian thing you got going on, right? I'm always an optimist, and I think that you're a good balance, a little yin to my yang. And I'm super excited to hear your thoughts as well.
All right. Thank you, Todd. I'm a fan of yours as well.
Well, I appreciate that. I should throw in there too, because Dan will probably wait till the end, but right, his market mentorship program is just awesome. I was already on my little Telegram today, checking out what Dan was talking about on the market. So I'm sure he'll talk about that a little bit later, but definitely worth something that you should all be checking out, because I'm a member and I love it.
Thank you, Todd.
Marketmentorship.com, guys, if you want to be the ultimate mortgage nerd and have access to Dan 24/7. Of course, he decides when he actually responds. So I'm not promising that he'll respond 24/7, but if you want to be in the nerd program, make sure you guys check that out. Also, we're going to be joined by Dan Keller. So we're going to have two Dans as our special guest. Dan is going to represent the street. So as all you guys know, because he's a regular in the mortgage coach community, he's a $200 million a year loan officer. And he watches Dan daily. He uses Rate Watch. And he's going to be jumping in with, "Oh, how am I going to take what Dan just said and create social media content around it, bring it into my conversations with agents, bring it into my conversations with borrowers?" Dan Keller will be here soon. So with that said, Dan Rawitch, why don't you rock it out and tell us whether inflation is friend or foe?
All right. Well, good morning, everybody. Thanks for joining. Sorry, I'm looking for my... Okay. I realize this is in full presentation mode. I guess I could shut off my other screen and it would be, but does this look okay, Dave?
Well, I see you, but I don't see your screen yet. So I don't know if you intend us to or not.
Oh, interesting. Okay. Oh, I know why, because I haven't shared my screen.
Yeah.
That's something you got to do. All right, let's try this.
And remember, guys, if you have questions for Dan Rawitch, we will have time to ask them throughout the call or by the end of the call. So whether you're watching this in Facebook, make it a comment. If you're watching the recording in YouTube, put your questions down below. But if you're here live, we'll get those questions answered live. And we see your slide, but we also see.
Yeah, I know. I'm going to blow it up right now. Here we go. Why is that not blowing up?
We'll tell you when it blows up.
Yeah, I don't know why it's not. Let me try this.
Yep, it's big enough now. It's the main thing we see.
It's still not going into presentation mode for some reason. Is that big enough though?
Yeah, that's big enough. And Dan, usually you provide your slides. Is that something you're still willing to do?
100%. Yes, absolutely.
So these slides after the call, we'll put them in the file section of our Facebook group. So if you go into Mortgage Coach Productivity Mastermind, there's a file section, and this will be well labeled and dated for anyone that wants to download these slides. So take it away, Dan.
All right. Yeah, and I think some of these slides would be really good for loan officers to share with realtors. I mean, that's always my goal, and that's my goal with market mentorship, is to give you the content and the confidence and the data to where you become the mentor to the real estate community. Because you don't really have to know that much to know more than they do. And that's not a knock on realtors. That's just a comment about society in general. They just know these little news blips they get, from sometimes some fairly unreliable news sources. So I try to provide data that I believe to be true, usually fairly well researched. So inflation it's a big concern for everybody. You probably know today bonds are having a pretty good rally, and it's because Australia decided to lock down again because of COVID, and there are parts of Europe that are sharing similar concerns with COVID. And so the message to the markets hate uncertainty, is that we might not be out of the woods yet. There might still be some problems with the economy, and that's why bonds are rallying. And the thought further goes towards, hey, if there's problems with the economy, that probably will overshadow concerns of inflation. There's a cross there that's a little scary, and that's called stagflation. But I personally don't think that's going to happen at this point. I think the economy, if it gets too weak, it's obviously going to take a toll on inflation. So I'm not going to jump right in and tell you whether inflation's friend or foe. We're going to get to the end, and then you're going to tell me if inflation's friend or foe. But what I am going to tell you is what's causing this inflation and what I think is going to make it go away sooner rather than later. Hey, there's Dan Keller. Hey, Dan. Make sure you watch the road there, buddy. So first of all, this is a look at what inflation has looked like over the last 100 years. And what you can see is it is transitory. I mean, yeah, there were years back in the early 1920s, actually 1910, 1900, where we had some pretty good inflation. There was a very specific reason for that. And that was followed by the Depression. So, and what was happening before the Depression was an economic boom that was fairly not really seen before. And then when we came out of World War II, we had a Fed chairman named Bretton Woods who decided to peg the U.S. dollar to gold, which in some ways was not a bad idea. But it did shift a lot of things in the economy. And then we had this incredible boom coming out of World War II. I mean, those were the real heydays. And that brought in, look, that was 1 year of terrible inflation. The inflation that I remember was this period here where Paul Volcker introduces bold anti-inflation measures. Inflation surpassed 13%. And so that was like 79, 80. Interest rates did go through the roof. But that also was tied to gold, because President Nixon, in all of his wisdom, decided, we don't need to tie the dollar to anything. Let's just cut her loose, because the fact is the dollar was out of control and we couldn't tie it to anything. So all of a sudden the gold standard was dropped. And for some reason, which I'll never understand, the world continued to trust the US and the US dollar, even though it's literally tied to nothing. And I laugh sometimes because a lot of, let's say old school, maybe less sophisticated, well, actually some sophisticated traders, they're bashing Bitcoin. They're saying, what is it based on? It's not based on anything. It's like, okay, what's the dollar based on? Nothing. The dollar's based on nothing. So when that happened, it did create this really, abnormal time, and inflation really stayed escalated during that whole period after Nixon and up until the late 70s. From that point forward, other than little blips here and there, and you can see in 1990-ish, we had a little bout of it. But each one of these bars is just a year. And so I will tell you that inflation has always been transitory, because to me, the opposite of transitory is fixed. It never goes away. And you can see here over the last 100 years, it always goes. And the reason whatever brings inflation is going to have a lot to do with what takes inflation away. So next, these are the things that inflation's, the components of inflation. And I cannot stress this one enough. Can anybody tell me what's happened with housing? Inflationary? Hell yes. So we know that housing is insane and will continue to be insane Rents are going through the roof, which is a whole nother topic I do want to address. It's the reason why people have to buy homes right now. But is that a fair thing to really look at when you're thinking about inflation? I don't think so. I think that this housing thing it's something that's outside of the entire economy, and we do feel it, but we don't feel it like we do when we buy clothes or education or healthcare, recreation. How about transportation? Is that important? Yes. Does anybody think what happened to used cars? I have a Ford F-350 pickup truck that I tow my fifth wheel trailer with. And I think we paid $74,000 for it in 2017. That thing I could sell for 85 right now. I've never seen anything like that with a used car. We have a used Range Rover. I mean, really used. I think it's a 2012. It's probably worth way more than we bought it for. So the used car, but we bought it used, by the way. It's not worth what it would have been new. So we have these really huge, big components of inflation that are absolutely elevated, and they're causing a majority of the problem. And these are things that in and of themselves, the Fed would not react to. The Fed would say, okay, well, fine, used cars, that'll equalize. Home prices, they'll equalize. I see Todd and Dave. Do you want to comment?
I do want to comment because, guys, remember I kicked off this call. Wherever there's chaos, wherever there's challenge, there's opportunity. And I do want to highlight, opportunity number one, guys, the fact that appreciation's up. That means equity's up. And guys, that means there's a lot of cash out refi opportunities, home improvement opportunities, rents are up. So, that's another opportunity. Do rent versus own analysis and help families get clarity and confidence around going from renting to owning right now. So I just want to make sure we called out those two opportunities at this point. And Dan Keller, feel free to jump in anytime. When you turn on your camera, we'll know you're ready to, be hot mic. And remember, community, if you have questions or comments for Dan, put them down below. Anyways, keep it rocking, Dan.
Yeah, I'll take the cameras as take a breath, Dan. So just to touch on what Dave said, it's huge. Oh, there's Dan. I got to take a breath. You're muted though, Dan. Okay, keep going. All right. So, Dave touched on appreciation and he touched on rent, and it brings a story to mind. And I'm sure some of you have heard me share this story, but it's just so important and so meaningful to anybody that's sitting back and thinking, oh my gosh, maybe the house payment's going to be $200 more than rent, or whatever that number is. So back in like 2015, we helped my oldest daughter buy a home, and she had to go out into the country and buy the home in Red Bluff, which is actually where I am right now. And she paid $245,000 for a 3-bedroom, 2-bath ranch style home. Excuse me, guys, I'm losing my voice. And it's on acreage. It was old and dated and certainly needed a lot of updating, but just a great family home. I'm talking the white picket fence, the whole thing. And her payment at that time, she got an FHA loan and put down 3.5%. So we're talking about less than $8,000 down. We got the seller to pay all the closing costs by plug your ears, paying a little bit more for the house. Built that in. Seller paid the closing costs. And I suggested she get an ARM, which most of you would have said, well, that's the dumbest thing I've ever heard. Fixed rate loans were at that time 3 3/4. Well, the ARM was 2 3/4. 5 years later, guess what her ARM adjusted to? It's 1 3/4. So it's been an amazing decision. Her payment is $1,600, which in the beginning she kind of freaked out about. They were paying like $1,400 for a really crappy, I'm talking crappy, like Jerry Springer style home in Concord, California. And this home is nice that they bought. And we're talking about a payment to $200 more. And I told her, Ash, someday this payment is going to seem small to you. I don't know when, but I'm telling you it's going to happen, and we're going to make this work. And I'm sure most of you know guidelines 100 times better than I do. But I was able to be a non-occupant co-borrower with her. We were able to use my credit score, not hers, because hers was a bit challenged at the time. We were able to give her 100% of the down payment because I was a non-occupant co-borrower, and it made the purchase easy for her. Fast forward 5 years later, do you think that, oh, by the way, her payment's not $1,600 anymore, it's $1,400 because the ARM loan went down. What do you think happened to rent in the last 5 years? I can tell you that home that was $1,400 a month in Concord is now renting for $2,200, $2,300, maybe more. We did some I would say fix and flips, but we fixed them and rented them here in Red Bluff also because my daughter was here and it was an opportunity. And these homes, we first were renting them for $1,400 a month, and we had realtors tell us you'll never get that in this town. This is kind of like I don't know. It's a different town. It's I'm not going to slam it because I like it. It's a cute town, but we put granite counters and really did a good job on these homes. And we got $1,400, and the realtors were shocked in this town. It was the highest rents that anybody had seen. And it just proved that people in small, lower income, sort of a little bit maybe toothless towns, methy maybe, will still pay for quality. Those homes now are renting for over $2,000 a month. So the point to the story is what seemed like a high payment now is like nothing. Like she couldn't rent garbage in her own town for that amount of money. That's what inflation does. Your mortgage payment stays right where it is, and your house goes and your house payment stays right where it is, and your house goes up. Her house is now worth over $500,000. So my 38-year-old daughter, who has lived hand to mouth, as most people do in America, and certainly a lot of people in their 30s and even 40s, she has $500,000. She has $300,000 equity in her $500,000 home. Because, by the way, another great, plug for Mortgage Coach. I don't do loans, so I don't use it, but Dave gave me an account way back when, and I still play with it. I showed her, if you make that extra payment, because your payment went down when the ARM rolled, I think her savings was it was almost $200 a month. Her mortgage is getting paid down so fast. She kept making that same payment. So that's what makes inflation your friend. And if anybody thinks rent's going to be slowing down here, I think they're wrong. I think rents are going to continue to fly. So inflation is not necessarily a bad thing. It can be over time, but if you want to say what your foe is, it's deflation. And so the Fed has been really smart about guarding against deflation and wanting inflation to run a little bit higher. Do you have something, Dan? Dan? Oh, I don't think he wants to talk. Oh, are you trying to unmute? Oh, there he is.
Yeah, I got you. Can you guys hear me okay?
Yep, we got you.
Yeah, I think for the first time, this is to kind of piggyback on Dave Savage, what he just said. For the first time in a while, I had a homeowner the other day that we're talking about a cash out refinance. And they said, well, I just don't want to pull out a bunch of cash because I'm afraid that the market's going to crash. And then I'm going to be underwater on my house. So I had a conversation with them in regards to my professional opinion. But let me ask you this, because I think this is something Dave and I talked about the other day as a part of my 2022 business plan, where rates are going to be higher. So maybe doing the term rate reduction refinances may go away, but a lot of people are equity rich right now. So options around pulling cash out to pay off debt, options to maybe pull money out to renovate their house, et cetera. How would you, Dan Rawitch, answer that question if a homeowner said, I don't know about pulling cash out right now because I'm afraid the market could crash and I may be underwater on my house?
Well, I guess I look at it differently. If the market did crash, which I don't see it happening, I could soften, that would be normal. In fact, I told our option students this morning, trading has been going exceptionally well. And what I'm trying to teach them is positions pull back and then they jump back up again. So the market breathes. And when it inhales, it's bringing that oxygen in and it's expanding, but it has to exhale to let the other stuff out. And so, at some point the market may exhale, but it's not going to stop breathing. I don't see that happening. So specifically to your question is, let's say that your home went down $50,000. Well, you lost $50,000 of equity. You did. it doesn't change anything. If you take cash out and you do something really good to help yourself with that cash, you pay off high debt, you add a room that you always wanted, you put it in the markets, which, you know, the stock market has over the last 80 years averaged over 8%. You know, people forget about that. It crashes sometimes, but over the long haul, buy and hold. So you're going to pull cash out at 3% and put it in the stock market. But the point is that 50 would be gone, but at least now you have liquidated some of it and you put it to good use instead of just watching it evaporate. That's how I would answer that. If you have something to do with the money, you should do it.
I love that. So I take away, you're losing $50,000 in equity, but you're not losing $50,000 in cash. That's you're not losing $50,000.
No,
that's big. I have one more question because we're talking a lot with realtors.
Dan,
yeah.
Before we go off that's how Dan scripted it. I want to, after you hearing that, I want you to put your Dan Rawitch script around it, and you know, I'll be the borrower. Hey, I'm concerned about taking that cash out because of inflation. And now, Dan, tell me how you're going to respond after hearing Dan.
I love that. Oh, are you asking me how I would respond?
Yeah. Totally putting you on the spot.
Come on, let's go.
I love it.
Scriptapalooza.
I love it.
Totally putting you on the spot.
I love it. Well, I think depending on what our goals are with the cash out. So if we're putting it into the market, if we're using it to buy, this is what I said. If we're using that money to pay off high interest credit card debt, or we're using that money to purchase investment real estate, in my opinion, and this is why I'm on the call, because I want to make sure I'm giving the best advice. In my opinion, one of the best ways to beat inflation is low interest rates. So let's go out and buy an investment property. Let's go and buy a second home at 3% or 3.5% to beat inflation. So as long as the objective is to pull money out to beat inflation with a game plan, you're going to win. And I did not say this, but what I would add to that is if the market were to crash, you leveraged inflation, you leveraged debt, you didn't lose $50,000. So that would be my anchor. That would be my tie down.
And just mortgage coach community, you know, this conversation started at 9:18. So we're 5 minutes into it, pure gold. And now I'm going to lean more towards, because we're in housing, we want to help realtors. We're really going to lean on the family says that. And then you talk about how real estate is the greatest hedge for inflation. And it's a great time to buy second home, rental property. And we really drive real estate. And then here's the other thing, guys, take this to real estate. You just got a 5-minute to 15-minute lunch and learn with agents around how inflation is awesome to help them sell more homes, and how you and them are going to partner to put on some buyer event where you talk about this. You got a great headline. I'm sure Dan's going to run with it, but I guess we're 5 minutes in, so I think we crushed it. I'll let you keep going, Dan. I just want to make sure we didn't fly by that.
All right. And I love what Dan said. I can't remember exactly how he said it, but you're taking inflation that everybody is fearing and you're leveraging it. I mean, because if you pull that cash out and you buy a rental property, inflation is going to continue to drive your rents up. It is a great hedge against inflation. The cash isn't doing you any good, we already made that point. So that, I think the rental property argument is a very good one, because I do think rents are going to continue to climb for some time now. Okay, so just real quick, this is inflation going back to the 1800s. And you can see, in terms of just looking at a 300-year look, it is always transient. It peaks and it falls. And there's been really strong reasons for this peak and for this peak. We talked about it. At the end of my presentation, I'm going to show you a chart on interest rates that goes back to the 60s. And what you're going to see is it almost perfectly mirrors this inflationary chart. Rates went up and up and up. And when inflation peaked and started falling, rates continued to fall and have fallen for the last 40 years. I don't think that trend is done. If, again, I'm a chart guy, if you backed away from the picture and you were to draw a line down, now this is a little bit older, but still pull inflation up into here, maybe it's still a downward trending line. I don't think that that's going to reverse itself. I just think this is a blip, and I'm going to give you reasons why I think that. First of all, if you look at interest rates around the world, and you look at what I would say would be our comps, they would be Germany, which is a tiny little guy in here, minus 5%. Italy, minus 5%. Greece, minus 5%. Sweden, minus 5%. Now, some of these economies are much worse than ours. Ireland, for instance, minus 5%. Finland, I actually don't know what's happening with their economy. I think the last I looked, it was worse, minus 5%. So, oh, and of course we have Japan, minus 1%. And this is the highest their rates have been in several years now, because Japan's actually making a comeback. And Japan is usually my number one reason for telling everybody that all of the stimulus and all of this monetary stuff that the Fed is doing is not inflationary. And Japan is perfect proof of that. You know, for the last 20 years, they've been doing everything they can to try to stimulate their economy. They're finally just stimulating it, and their rates are still below zero. The next thing, again, is looking at GDP and what does growth look like? Well, you can see in 2020, the United States was negative 3.5% GDP. Now that was pandemic related, but do you know what it was before the pandemic? It was like 1.8%. So we're talking about an economy that cannot catch its breath. It never caught its breath after the last recession. It has habitually run below 2%. That's too low for GDP. Now, historically, when you come out of a recession, every other recession except 2007, GDP does jump in the 5 to 7% range. So we're seeing a normal reaction to a post recession. So if you look at 2021, GDP ran to 6.5%. That's on the low side of normal if you go back and look at every recession in history. And in my opinion, this was frighteningly low, given that we shut down the entire world and then woke it back up. There was a lot of catch up, a lot of revenge buying that was going on here. Where do we think we're going in 2022? 3.5 is the forecast. I don't think we're going to make it. I'll be surprised if we hit 3% inflation in 2022. Okay, so you've got GDP, you got interest rates. Now I'm going to kind of share with you some reasons why I personally don't think this inflationary thing is going to last. I'm not saying it's going away tomorrow, but I am saying it's not going to be around very long. So these are the job openings rate, and this is the rate that people are quitting their jobs. And you can see the job openings rate is higher than it's been, I think, in history. This chart only goes back 20 years. And you can see the rate that people are quitting. We haven't seen anything like that since, the big rush. Well, actually, no, we're close to 3%. This is above a 20-year high. You have something, Dan? Okay, just checking in. Just want to see your face. Well, thank you for that. So this is a problem, guys, because you know what? If you can't produce stuff, you can't buy it. So as production continues to get squeezed, we end up with these inventory shortages. And on one hand, yes, inventory shortages, that's the old supply and demand law. It can create some inflation. But the fact is, if you can't buy anything, the economy is going to suffer. And at some point, prices have to drop. So that slide's a concern. Disposable income, you can see what's happened. It's not going anywhere. I mean, look where we were, post-pandemic. It's done nothing but fall. It had a little bit of a jump here. But for the most part, not too much is happening. Because you got to kind of shave off. You got to shave off this little orange thing, government social benefits. When you shave that off, you see that we are pretty much where we were prior to the pandemic. Whatever this number is, it's very close to where this number is. So yeah, that I think that's the point. You can see all other income is actually gone down. So this concerns me as well. This says we don't have an economy that's on fire. This is shares of household behind on rent and mortgage payments. Now you can see the West is doing much better than other parts of the world, but this is still a big problem. We still have a lot of people behind on their rent and their mortgage payments. I mean, more than we've had in a really long time, almost recessionary levels. Now we're seeing a lot of people are making a comeback, but it's still not where it needs to be. Retail inventory to sales. This goes back to my nobody wants to work, nobody can make anything, inventory suffers. So this excludes motor vehicles and parts, but you can see what's happening here. Inventory and sales are at least a 14-year low from what we can see. And they've got a long way to go before they normalize. When they normalize, inflation will be gone. You can see this is beginning to have an uptrend. This is 1 year growth from 2018, 2021 in inflation. And there's no doubt this has been an extreme jump. And you can see, you know, across the board, really, except services. Services is still, I guess we're now just about where we were pre-pandemic. And other things are now more expensive. This is going to normalize, and I'm going to show you why in a minute. This is the 1 year core goods of CPI, just buying stuff. And again, it is too high. It dropped, it came back up. This is a concern. I'll address that toward the end here. I think I skipped that one. It's okay. Okay, this is one big culprit. We talked about this. This is the CPI owner's equivalent rent and rent of primary residence. That's a problem. That is a big component of inflation, and frankly, I don't think it should be. The Cleveland Fed measures something called CPI stripped, and they actually strip this out because they don't think it's fair to really concern that to have that be a concern when they're thinking about interest rates. For us, this is the friend of inflation. This is why you need to buy a home. This is not going to stop, in my opinion. And I don't think this is going to stop either. So it's going to continue to artificially increase inflation, but it's also the reason why I think being in our industry, inflation is not a bad thing. It is when you're trying to do just refis and you want them to fall in your lap. That's fun. We'll have that again. It might be a while. I have bad news. You might have to go work a little bit to go get your loans. And I'm not trying to be facetious or mean. We got a little bit spoiled. I mean, I know people, especially some newer loan officers that came in, it was just like pennies from heaven. The more senior LOs understood this, and they didn't focus all their energy on just that. And hopefully you'll learn from this if you're new. You usually only take one time to learn. There's back in what year? I think 94 was a huge refinance craze. And then it died just as fast. The Fed chairman at that point raised rates 17 times in like 2 years. And there was a t-shirt that said, "Dear God, please give me one more refinance wave. I promise I won't blow the money this time." So get yourself that t-shirt. So this is PCE, which is personal consumption expenditures, which, by the way, Wednesday, these numbers are going to be released. These numbers are watched more carefully by the Fed than these numbers. I'm not saying this isn't important, but this is way more important. And you can see PCE is less weighted toward housing, and it's much less weighted towards transportation. So this becomes a more important number. And by the way, we don't actually look at food and energy when we look at the CPI level. We look at the core inflation. That irritates a lot of people because they're like, "Have you been to the grocery store lately? Have you been to the gas pump lately? How can you exclude that?" I get it, but it's so volatile and it's so up and down. It's not a fair measurement of CPI. So you have to take those things out. But this is just good to know the comparison. And you really want to watch this number on Wednesday. I think this bond rally we're having right now is going to easily take us through Tuesday. But the PC numbers could end the party. And this slide, I have no idea what it is because I cut off the label and I can't remember. Oh, wait. Oh, this is so important. This is so important. Oh, man. Guess what this is? This little line here is how much it costs to ship one shipping container from China to the US. This number was about $1,200. This number is now 18,000, and it eclipsed 20,000 just a couple months ago. It was 22,000. Let me put this in perspective for you. A television, a little flat screen television in a container at these normal prices here was 37 cents. That's how much it costs to, sorry, lie, $1.37 to ship that TV on a container. $1.37. You know what it is here? $50. Do you know how much a TV costs? Like, we just bought this little one for this Airbnb house. What do we pay for that little TV? Like 99 bucks for this small TV.
It was a 4K too.
4K smart TV. That TV would have been about $49 if the shipping cost didn't do this. This is a really material thing. Have you been into a Target lately? This is an actual picture of Target in Contra Costa County. Now, why is that happening? Well, this is a huge problem. And the headline here is pretty good. The supply chain catastrophe is not happening because Americans are buying too much stuff. We're not buying anything more than we were. It's just that the supply chain is very broken. We essentially turned off all manufacturing, all creation of even the raw goods and materials. The buying still continued in the pandemic. A lot of durable goods were bought like crazy. People were on Amazon like nuts. So it's not like we completely stopped buying, but we stopped making. And now the buying has accelerated to normal, maybe a little bit more than normal, just because we still have some revenge buying. The manufacturing just can't catch up. This line of trucks is every single day near any port in America. These trucks cannot get in or out. This is a bird's eye view of Long Beach, California. Each one of these containers are 40 feet high. Some of them are stacked 6 to 8 high. They have these huge cranes that can kind of move one to get to the other. It gets worse. This has never looked this way before. We have 111 container ships floating off California's busiest port. 111, like 30 was considered way too many before. Look at how big these ships are. You can only fit like a couple of them at the docks. Look at this. I mean, to me, this is just overwhelming picture. So now they're fining ships. I forgot the number. It's like $100,000 or $50,000, not ships, but trucking companies for not picking up these containers. The trucking companies can't pick them up because they don't have trucks. And even if they had trucks, there's no place to put the containers. Containers are getting dropped lengthways, blocking 5 or 6 other containers that are parked parallel in yards all across America. And it could take up to 3 months to move the frickin' thing that's in the way. I mean, this is a huge problem. But I ask you, will this problem be here a year from now? No, there's just no way. There's no way this doesn't right itself. Now, unfortunately, we're not going to be building docks and shipping yards and all that stuff. And the problem really is, this has happened before, not to this level, nothing to this level. So we say, why weren't we ready for this? Well, you can't have that many freighters. Normally, there's about 5,000 freighter ships in America. Sorry, in the world. And normally there's at least 10% that are just sitting there in reserve, because you can't use them all the time. It would be too expensive to keep all these things. We need probably 20 more ports like this, but you're going to build them and have them empty most of the time. So it's these rare occurrences when these things just get backlogged like this. When this goes away, and I've been saying this now for a couple of months, when you see this line here appreciably drop, you can say that inflation will have peaked. Until then, I'm not sure we can say inflation will have peaked, because as I told you, the cost of a television is up because of this, and only because of this. It is a problem. There's no doubt, but it is absolutely a transitory problem. Did you have something to say, Dan?
So yeah, if I'm making a PowerPoint slide for a lunch and learn for real estate agents on what this means to them, what this means to us in regards to our markets and our jobs, you just dropped a ton of value and a ton of like almost, over my head and definitely over real estate agents' head. 3 things, Dan, in summary, 3 things from what you just said we need to pay attention to that'll impact us in the next year relative to inflation.
Oh, you're putting me on the spot now. So number one, inflation is here, and it's here now, and it's going to continue to drive home prices up, and it's going to continue to drive rent prices up. It also, in the short term, could drive interest rates up. That does create, in my opinion, some sense of urgency to buy a home and to buy rental properties. Number one. Number two, the reason I don't think that inflation is going to crash the market, because it has in the past, is because it's transitory. And it's transitory because of all these slides. These are fun slides. These slides mean something when people see them. They know this has never happened before. And when they understand the components of inflation, and you start stripping out shelter and you strip out transportation, you realize inflation, while it is more of a friend than a foe right now, it is going to go away. It is going to pass. And the question is, will that be 6 months or 1 year? But I don't think we're going to be looking at this problem in 2023. Is that, I lost count, but I think that was 3. I can't remember past 2. So this is a chart of interest, the 10-year bond going back to 1964. And I want you to kind of try to go back and visualize. Let's see if I can put my finger on it fast enough. Yeah, okay. No, is that it?
Hey, Dan, I want to jump in right here, guys. So we got about 18 minutes left in the call. So I just want to do a little time check. And then I want to make sure everybody's connected the dots. You've gotten one really, content, scripting, slides for some great realtor value adds that are going to help you bring some content and some facts that are happening in the market to help realtors sell more homes and to do more cash out refis, which are 2 incredibly hot trends for a mortgage coach. And you guys are also uniquely positioned to be able to present these things. If you don't have a mortgage coach, cash out refi, and I would say 2 or 3 really good stories built out, you're losing loans. If you don't take from this conversation and build out a couple slides and a couple total cost analysis for your next real estate meeting, you're costing real estate agents homes that they could be selling, and you're also not serving your consumers. So anyways, we got 17 minutes, guys. Just want to make sure you had a time check, Dan, so you could get your best content out. And remember, guys, put your questions down below.
Yeah, we're getting close to the finish line here. When you looked at that inflation slide, you saw inflation running up to the 60s and then running down from the 80s. So this is interest rates running up from 64, peaking in 1982. And ever since then, it's been on a downtrend. Now, I'm a technician. I look at charts and I draw charts for a living. This is how we make our money, knowing what these charts are going to do. This chart, since 1982, every single time we've touched this trend line, we have fallen, and we've fallen pretty hard. This is really called a megaphone. These megaphone patterns are considered very bearish. Well, because this is a interest rate chart, we want it to be bearish. We want it to go down. So that's a really important point. Now, and it was really key here. It doesn't matter. I don't want to brag, but I've been able to call each top just by looking at this thing. Now, here's the problem. It looks to me like it could be heading up. If I were to draw a trajectory of the current shape here of how we're going up, actually, this should be moved over. Where this trajectory intersects this line, there's a possibility the 10-year could hit. I don't know if it's going to do it, though. And you can see it doesn't always. You can see many times it starts and it stops. The next important key here is this magenta line is the 50 period moving average. So this line is really 50 months average movement. And you can see how it is an incredible barrier for rates to cross. And the times that rates have crossed it, they have run up to the top of the trend line. When they don't cross it, they run down considerably. And so I think that's an important point. And we touched it already this year, fell hard, and we've touched it again and fallen hard. Not that hard, but from 1.80 to 1.55. So I think that's important. This is a very long-term look. If you blow that image up, so this is a shorter time frame. It's still looking at each one of these candlesticks represents a month. And you can see how the last time we touched it, we fell. But we've also formed this wedge pattern. And there's two things on this slide I want to talk about. One, this wedge pattern. These are powerful patterns. Whichever way you break from this wedge, you will move. It won't be a small move. It'll be a pretty big move. So yes, I'm hoping that we hold this wedge. The next point here again is this 50-day moving average happens to be on the wedge. So that's almost a double wall of resistance, which I'm hoping for. I don't want to give this up. Lastly, these lines going up, if you follow me on Rate Watch, we teach extensively on Fibonacci and for our options class. I'll give you a great example. We made some pretty good money on a few trades just this morning before the call using Fibonacci. So in this particular case, rates went from here. Sorry, my phone's going to here. Now, each level of Fibonacci, I think of it as a rung on a ladder. And so we started here, rates with the peak of rates for this period in 2019. We came all the way down here. We bottomed out at like 0.63 on the 10-year, and then we started climbing. Well, don't you think, going back to my analogy of everything breathes, the market inhales and it exhales. So, you know, it breathed in and rates got better and better and better, and then it has to breathe out. Fibonacci 38.2 level, and I should talk about Fibonacci real quick. I know that if you follow me, you know what it is already, but to me, it is the most magical thing in the entire world. It to me is the eighth wonder of the world. No, you're like the first wonder, honey. My wife said, I thought I was the eighth wonder. You're a wonder, all right. Fibonacci was a mathematician, economist in the 12th century. And somehow he stumbled across these numbers. And these numbers, you can see, they are a 2, 3, 6, 1, 5, 8. Everything in here is a Fibonacci number that you can see. And what he realized is these numbers kept repeating themselves. And he found that even the distance between your eyes, as it relates to the tip of your nose, those are Fibonacci numbers. The length of your mouth, as it relates to how much it opens, is a Fibonacci number. The amount of thorns on a rose stem, the amount of roses on the stem, the amount of petals on the rose are all Fibonacci numbers. Later on, scientists realized that DNA is not largely, 100% comprised of Fibonacci numbers. Later, these became called the golden sequence. I don't know why, I don't, but I do know they work. And I just drew this. I didn't make this work any certain way. I took the top of this interest rate move to the bottom, and a normal Fibonacci retracement is 38.2%. That's the Fibonacci number, 38.2. Then it pulled back, and a normal pullback is 23.6. So right now we're operating within the Fibonacci, very normal and healthy retracement. If we give up the 38.2 level, think about as a ladder. You are compelled to go to the next step of the ladder. That would be the Fibonacci 50 level. I don't want that to happen. I don't think it's going to happen. But again, this whole transitory inflation could cause it to happen. But the way we use Fibonacci in trading is, I already knew this was coming. So if I were long here, I would sell here. And on this pullback, I would buy more. I would sell. If it breaks through, I buy more. So this morning, Apple did just this. It essentially ran up, pulled back. It held this Fibonacci 38 level. And I told our group, buy it. And then it ran up again, pulled back. I said, buy more. And then it ran like crazy. Same thing happened with Facebook this morning. So Fibonacci really works. Just be aware of this. I talk about Fibonacci every morning when I do the Mortgage Coach release, and on market mentorship, I teach people how to draw the Fibonacci lines. So this is a little more drilled down. These are weekly candlesticks, not monthly. Once again, the wedge, using the weekly, we're at the top of the wedge. Number 2, I drew Fibonacci from here, the very top, all the way down to here, the very bottom. And in this case, Fibonacci ran up to 50, which is a pretty good retracement. Beyond 50, we start thinking reversal, not retracement. Reversal would mean all the way up. 50 is a good sign. It pulled back. It did go through this Fibonacci level, but it held it several weeks, 4, 5, 6 weeks here. If I were to blow that up, it held the Fibonacci 38 level. And then it gave it up and it came down to my trend line. And once again, it ran up to the trend line, and now it's holding this Fibonacci 38 level. So this is where I think we sit for just a little while until this inflation rears its head, stops rearing its head. You guys know that I love to come here and give you good news. Speaking of which, I will pat myself on the back, but I have to give credit to another person here. The last time Dave had me on Mortgage Coach, I believe it was September 13th or 14th. I told you that there were some major time cycles coming together and that they could cause interest rates to bottom, and that interest rates might just reverse themselves. Well, I got to show you how, because a lot of people they don't really believe this stuff, you know. This was September. Let's see here. Yeah, so September 10th, 11th, somewhere in here, I said I think that interest rates are done. I think we're going to see a pretty big jump. And just in the days and weeks following that, the 10-year went up almost 50 basis points. And this was all because time cycles coming together, going back 250 years, were all coming together and intersecting one another. I talk a lot about time cycles. I follow a guy named Andrew Pincelli. He is a world-renowned time cycle guy. And every month I get, oh, tell me I don't have it, this. I know what dates to watch. So I know that I draw charts. And so I knew on August 17th, something might be happening with equities. And if the prices are getting real toppy and hitting the top of the chart, then I know it's probably going to be a reversal. The accuracy of this is unbelievably crazy. So it works. We also trade a lot with seasonality. Oh, I see Todd and Dave. Sorry.
Oh, it's okay. So we got about 7 minutes. We can go a little over. So by the way, guys, that last time I had Dan, it was called the August 2021 market update. It was on August 10th. And to your point, Dan, I mean, Dan is always on it. And when he's not, he can explain that too. But if you guys are not watching his daily update in Rate Watch, you're missing one of the biggest gifts in Mortgage Coach. If you're a new loan officer, like when new loan officers come to business, I'm like, watch Dan Rawitch's morning update and Rate Watch every day for 2 years, and you will be an absolute expert as a mortgage professional. And then, as you said, Dan just covered, his market mentorship program, where he'll really teach you, these concepts. But by the way, guys, he's teaching you these concepts so you can take this and now you can be a leader and a market expert to agents, to consumers, like Dan Keller has. So I just want to remind you guys, we're about 6-7 minutes till the top of the hour. Anything you want to make sure gets covered, and then we'll bring Dan Keller in also. Anything you want to make sure you cover, Dan?
Well, while I'm patting myself on the back, my arm's still not tired. In March, I spoke, and I don't think it was with you. I might have done one that week too, Dave, but it was the California Association of Mortgage Professionals. And I said, I think that rates have topped. I think they're going to come down almost to the day. They fell extraordinarily big. And this is actually when I was on the mortgage coach, which Dave just said. So again, I know it sounds like I'm bragging. It's just understanding how to read this data, how to interpret this data, and synthesizing it all. And that's what I do. That's what I love. Some people would say it's boring as hell. Some people love it, but for me, it's really interesting, and it's what I love to share with you guys. Also,
throw in real quick, Dan. Can I just throw in a quick thing? I mean, I think a lot of people I talk to are scared of your market mentorship because they're worried about the options trading part of it. I don't trade the options. You know, every once in a while I'll do something, but I don't have time to sit there and watch it like Dan and all these other guys do. But it's the weekly newsletter and some little tidbits he puts out every day showing these graphs that I use to educate my team and educate myself about what's going on. And so you don't have to, you know, certainly what Dave mentioned, the free stuff in that he puts out for Rate Watch is priceless. And so start there. But if you want more, then that's why I would join Market Mentorship. That's why I get it.
Thanks, Todd. I appreciate that. The other thing about Market Mentorship is if you don't have time to just trade all the time, every Sunday I put out a weekly video. I talk about what happened last week in the economy, how that's affecting the markets, both interest rates and stocks. And then I give somewhere between 5 to 10 stock picks. And we now have in 16 weeks, we've had only one losing week. Our win rate on these stock picks was 85.2% as of last Sunday. I track it. I post the results every week. This week is astronomical how much we're up. So if nothing else, you could join. It's very inexpensive, and you know, take one stock pick a month and probably do well. Although what I tell people is I don't care if you just buy one share of stock, but if I pick 10, I'd rather see you buy one share of all 10 than 10 shares of one, because trading is all about probabilities, and the probabilities are we win 85% of the time. If you pick that one, you might pick the wrong one. If you pick 10, you're going to make the probabilities work for you. So thanks for that.
Dan, anything else you want to make sure we cover before we wrap up today's call?
No, I think we're good.
Well, let's make sure we talk about Richard real quick, because we've got a couple big things going on. So if you could tell us about the post you did a couple days ago on Facebook, and then Dan Keller piled on, and let's make sure you cover that.
Okay, I'm going to pull up the let's see here. Where is he?
And Dan, are you in a place where you're unmiked and you'll be able to jump in here in a minute?
Yep. I'm good. Yep.
Oh, shoot. I gave Robert the link anyway. So I'll just kind of cut to the chase here. I've gotten to know a man, and he's gotten into my heart. Not necessarily because he's like the sweetest.
Hey, Jen, why don't you stop sharing your screen real quick, just knowing that there's nothing on the screen of value. I mean, David, there was something of value, but now we've seen it. So I don't want to.
Dave, everything is
sound right.
There you go.
There we go. Now we can see the man, the myth.
I thought we were friends. Did Robert stop sharing me? No.
No, we got it. We can see you now.
Thanks, Robert. So I've gotten to know a guy, and he's really gotten into my heart. And it's not so much like the sweet, nice, gentle man. He's actually kind of a crusty old guy, but lovable as hell. His sense of humor is amazing. And as I've gotten to know him, I realized the sense of humor, which is over the top, is masking this incredible amount of pain. I found out that he's suicidal. He's literally put a gun in his mouth twice in the last 2 months. I don't want to get too choked up here. He's a Vietnam vet who was blown up, bombed, and he's been partially crippled for most of his life. He walks, don't get me wrong. He's not like one of these guys that lost limbs or anything. So I don't want to over exaggerate this, but when I watch him walk, it's hurting him. Make matters worse, he was hit by a bus in 2008 that ran through a stoplight when he was on his bicycle, broke almost every bone in his body. He lost everything, and was completely homeless, living on the streets. He then, in 2008, I don't know if you remember, but all these move out jobs were over the top. People were leaving their homes and trashing them, and property managers asset managers needed somebody to come in and clean all the crap out of the houses. He started doing that for a couple of management companies. and he saved up enough to buy his first trailer, and his trailer's sitting out by my RV, out in this horse pasture. It's really pretty bad. But he made enough money to start buying equipment. He never stopped living in the warehouse that he rents from the property management company that stores his equipment. But what's happening, even since I've known him, is he can barely walk now, and the physical labor is killing him. He cannot work. He's 80 years old. He has no family. Everyone's died. All of his friends are gone, and there's nothing to fall back on. He bought a home in February of this year using his VA benefits, and the home's gone up. And where I got really aware of his financial situation is he was asking my advice. He's like, I think I can take cash out of my house, and I think it would be the difference of me being able to survive. So we went through this whole thing, and that's when I realized it's not that he doesn't have work, he can't do it. He's still living in Santa Rosa. His home is in Red Bluff. We're helping as much as we can. We've got the home on Airbnb. We're hosting it. We're renting rooms for him while he's gone. When he's here, he doesn't even sleep in his house. He sleeps in this horrible old beat up trailer out in the horse pasture, because he's so afraid he's going to lose the home. He doesn't want to get used to, what that bed feels like. So I started a GoFundMe account. It just hit me. I don't know if everybody has these fears. I like to talk about abundance and all that stuff, and I live my life that way. I've written a book about that. Deep down, I think that I have scarcity issues. I think just growing up, my parents struggled, grew up in this terrible neighborhood, in a beat up apartment. And I know my parents must have talked about money problems. I have this fear of being broke. It's never gone away. And in fact, the more money that I've had, the more scared I get. I've always been at my best at the bottom, because it's like the fear goes away. But that was always been my biggest fear, of being 80, not having family. Thank God I have, loving daughters and an incredible relationship with them. He doesn't have that. I have an amazing wife who's 12 years younger. Yeah. So she's my long-term healthcare plan, but that's why I'm really nice to her. She's going to change my diapers. So actually sidebar, because it's funny. Sorry, Dave. My oldest daughter, Dad, can I just borrow $400? Of course, but can we just be clear so I don't get frustrated? Is it really a loan? Or she goes, Dad, I'm not going to pay you back, but I will change your diapers when you're in your 90s. So I got that going for me. But back to Richard, that's just my worst nightmare, and it's really hit me hard. So I started to GoFundMe, because right now his main goal is to pay off his credit card debt, which is about 15 grand. And if he pays off that debt, he has a total of 900 coming in from Social Security. We are, instead of staying at an RV resort in Red Bluff, which is actually one of the top resorts in the country, we're paying him to rent. He actually has an RV slot in the back of this house. He's on acreage. And I showed Dave pictures. It's gorgeous. When you look at horses, and it's all green and lush. And in some ways it's better than this RV resort, but we're paying him $600 a month, and I won't stop paying him $600 a month, because between that and Airbnb, he can almost make his house payment. But then he can't live in his house if it's on Airbnb. But if he pays off his credit cards, he can almost get by on the $900 a month. If I keep paying him $600 a month, then he's okay. If he doesn't pay off his credit cards, not so much. I talked to Dave about another idea. I don't want to complicate this, but we could convert his garage, which is a freestanding garage, into a studio, and that would rent for $80 a night. And Airbnb is hot out here. There's not a lot of options. Of course, it would be amazing to help him make 1 or 2 years of payments. I don't think he's got a lot of years left on this planet, and I would just love to make those years amazing. That's my story.
Well, that was beautiful, Dan. Love your heart, brother. And I know we're going to make a donation. Dan Keller, before I kind of share some thoughts on this, anything you want to say?
Yeah. I saw the post as well. And I just think that Dan, Rawitch, and Dave and Todd, you guys have done so much for the mortgage industry, and I think that we as the mortgage industry have been blessed over the last 2 or 3 years. Been blessed over the last 10 years because of the information that you guys give me. Listening to Dan's stuff every single day allows me to close more loans. It allows me to have better conversations with borrowers. Watching all of your top producing videos and following your lead, Todd, as an industry leader, has helped me to close more deals and grow and make more money. And I just think that I saw your post and we've been so blessed. And I want to encourage the mortgage industry, the mortgage coach community to step up for this guy. I mean, you hear a lot of loan officers talking about veterans, and it's at the deepest core of my heart to serve our veterans, and they're an underserved buyer community right now in our industry. And I want to encourage us all to put our money where our mouth is. And so I wanted to just, lift up Dan Rawitch and say, I'm 100% behind you financially. And I think the mortgage coach community needs to do this. And I think this is one way to give back to you guys for leading us and helping us be more successful. But this is an opportunity to make a difference in a person's life. And I think at the end of the day, all of the money that we make, all of the success we have, this is my personal belief, it's not ours. It was given to us by God. God gave us the talents. We leveraged guys like Dan and Todd and Dave to put those talents to work. And you know what? We got paid a little bit of money in return. But the way I look at money is it's not mine. And I want to encourage all of us to look at it that way. And we got an opportunity to help a gentleman right now. And I just personally want to raise my hand and say, I want to be the first person to get behind Dave, Todd, and Dan. And I want to encourage all of you other mortgage coaches. I know there's a lot of people that speak in your community that make a lot more money than I do. And I think if we could pool together some of these people, man, we could really change a guy's life and then give back to you guys. So I'm all in and I can't wait. This is just the start. And I know Dave and Todd, you guys got some stuff brewing that is going to help drive this mission.
Yeah, I just want to add one thing too, because Dave and I talked about this yesterday. The thing that really breaks me up is, like, if you fly on a plane right now, the flight attendant's gonna say, "Hey, anybody from the military, stand up," and they get applauded and they're thanked when they walk through an airport, and it's so beautiful and wonderful. Do you know what happened when these guys came back from Vietnam? They were spit on. People threw things at them. He told me stories that were so appalling of what happened to him when he came back from Vietnam. And not to pile on the grief here, but 1 week after his brother came back from Vietnam, his brother was like his best friend. They served together. His brother blew his own brains out right in front of him. Got so messed up in drugs, just didn't see a way out. And Richard told me the only reason I haven't pulled the trigger is because I remember what that looked like. Oh my God. Like, I've never heard anybody say those things to me.
So guys, this is obviously a tough situation. Dan is a good friend. So we're going to do a couple things at Mortgage Coach. And again, no pressure for anyone. If you do donate money, there's a link down below. Todd and I talked before this call, and the Modern Mortgage Summit and the Modern Training companies are going to donate $1,000. So we're going to kind of get the party started. But again, I'm not saying that number to put pressure on anyone. Just know that Modern, Todd, Win by Noon, myself are going to get it started. We're also going to do a call. A Tuesday in December. Stay tuned. Right now, the name of it's going to be called VA Strategies, where we're going to have top mortgage coaches teach and do training on how to deliver, how to put more heroes in homes, and how to use the mortgage coach to help put more heroes in homes. So stay tuned for that. It'll be a Tuesday in December, and we're going to have some amazing top producers focus a call, kind of like Scriptapalooza, where it's like, hey, and Dan Keller, what's your best VA strategy? So stay tuned for that. Again, the link is down below. Dan, anything else you want to add to this before we've got a few minutes over? Apologize to folks, but I think it's important. And it's not like Dan does a post like this all the time and makes an ask like this to his Facebook friends. And as far as I'm concerned, Dan Rawitch is much more than a Facebook friend to me, and he's much more than a Facebook friend to the mortgage coach community. So I wanted to make sure we, any friend that he's going out of his way like this for is a friend that I'm going to go out of my way for.
Thanks,
Todd, any closing thoughts from you before we wrap it up?
Well, no, I mean, I just love that. I think Dan Keller hit it on the head, right? Our community has really been blessed the past 18 months. And really for some of us, for me, 20 plus years, right? And I just think it's a good opportunity, whether you give $20 or $200 or $2,000. I think let's support the community. And then I can't wait for the event in December. I think I put a note there, put more heroes in homes. I think you guys give us a good title for that conversation, but I feel like it's a great opportunity. And we do all talk about wanting to support veterans in a different way. And I think this is just one way to get in there. And I, as always, got, a page of notes, and I'm looking forward to seeing the slides. And you guys now have a gift from Dan Rawitch to help you be better for your clients and better for your realtor partners. And so take advantage of it. When you go back, if you join late, when Dan Keller asked, hey, how would I use this with my clients and my realtors? That's how I want you thinking. I want you to take the slides and take action. Even if it's just taking one slide and then putting it up on your screen and then doing just a 2 to 3 minute video about what Dan said. Just regurgitate what he said so that you sound smarter to your people in your group, your Facebook groups and all that kind of stuff. That's your opportunity here today. So take action, come with a giving heart. Let's support Richard and his journey here, because certainly he deserves it. And I don't know what else I should be adding on here, but that's where my heart's at today.
Thank you, Todd. I can't tell you guys how much I appreciate this. I think Dave knows I have a little bit of a hard time receiving. Why are you laughing?
You do.
Oh, I do.
Deprivation.
Okay, that's enough. Buddy.
I
No, you can't go. Go ahead, leave. But anyway, I did want to recognize Scott Nicholson. I don't know if he's on the call, but he made a big donation, big enough to actually made me feel guilty. And I sent him a note and said, I want to send some of this back. He didn't respond, but so this is hard for me, and I do really appreciate what you guys are doing.
Well, you're doing it for Richard, and we're also doing it for a hero that served our country and has paid a dear price for that service. So appreciate you, Dan. Guys, stay tuned for our VA
Loser.
how to put more heroes in homes with Mortgage Coach VA strategies. Stay tuned for that. Thanks everybody for your time. We will have a call on Tuesday. Todd and I will be leading it. And right now we're leaning towards a fireside chat that will be how to turn gratitude into your competitive advantage. So we might update it. Who knows, we may have a special guest, but this Tuesday at 9:00, Todd and I will be having a fireside chat with the Mortgage Coach community. And, next week is Thanksgiving. So great time to be thankful. Dan Rawitch, thankful for you, brother.
Thanks, guys. Appreciate it. Keller, I don't know if you're still there, but thank you. See you guys.
Bye.
Always good to see you guys. Have a great weekend.